paying someone to invest your money is one of the first mistakes a lot of people make. Let me explain why. Welcome to another video. As always, if you liked the video, please subscribe, drop me a comment if you have any questions. So how come paying a professional to invest your money for you is a mistake? Well, let me explain. So the first thing is you have to pay them. Usually a percentage of your gains. So 1 or maybe even 2% of what you make on your investment every year. And this will eat up more of your profits than you think. An example is, if you pay 1.5% of your profits every year in fees, so if the stock market does 10%, you will only make 8.5%. The difference that 1.5% fee makes over 30 years is 24% of your gains. That's how much that small fee eats up of your profits. And as time goes on, it takes more and more. And after 40, 50 years, over your whole life, it might take up as much as 50% of your gains. Just that 1.5%. And if you invest your money yourself, you pay 0% of your gains in fees. So that's reason number 1. Reason number 2, 80% of professional money managers and advisors underperform the market. So you're better off buying an index fund. You will beat 80% of managers and you pay almost no fees whatsoever. And when I say underperform, I mean underperform the S&P 500, which is the benchmark for the US. Most of these studies have been done in the US. This was done by the Wall Street Journal, I believe. Another thing is, there's a middleman all of a sudden between you and your investments. And so you have to transfer your money through this middleman or woman every time you want to buy or sell an investment. And it's just simply inconvenient. You have to deal with a third party all of a sudden. It's you, the middleman, the broker, and then the stock market, instead of just you, the broker, the stock market, because everyone needs a broker. So it's simply inconvenient. And it can create misunderstandings as well. And just the simple concept of paying money to invest money is contradictory, right? Because you want to invest as much money as possible, right? You're trying to get as much money as possible and then put it into the stock market. And paying money to do that is the opposite of what you want to do, because you want to have as much money as possible. And since they're actually losing you money, you're actually paying money to lose money. That's in practically what you are doing. The other thing is, we're moving from an actively managed stock market to a passive one. People are just putting all of their money in ETFs, which means it's a very passive market. It's low volatility and just keeps going up and up and up. And passive investors will benefit from this. So the smartest thing to do now is to put your money in an ETF, because everyone else are also putting their money into that ETF, right? If you're buying an S&P 500 ETF, there's Apple, there's Microsoft, there's ExxonMobil, these companies. So everyone's putting their money into the S&P 500, so the S&P 500 goes up. But a manager might be looking at other stocks which are not included in any ETFs and will therefore not profit from the passive increase in the market. So I would say it's a passive market for passive investors. And speaking of passive, the way you do it is you invest in ETFs or mutual funds. These have fees of like 0.1, 0.2, maybe 0.5% instead of 1.5, and that can make all the difference. And they will usually outperform active managers. You can also pay 0 fees, but the only way to pay 0 fees whatsoever besides the actual transaction fee is to buy individual stocks on your own. This is the classic form of investing, where you buy companies on the stock market. shares of Apple, shares of Ford, shares of Amazon. You just buy directly, and this way you pay zero fee after you buy. Nothing, absolutely none, just when you buy and when you sell. So you could go also for blue chip stocks, paying great dividend, and you have to pay zero fees, and that way you will, the chance of you, if you just buy like the 5 or 10 biggest companies in the S&P 500, I think there's pretty much an 82% chance that you're going to beat every active money manager on Wall Street or wherever they are. So do it yourself for free. Don't pay anyone to invest your money. It's contradictory, it's old-fashioned, it's stupid, and you're throwing money out the window. So go out on your own. If you have any questions, just ask me. I'll give you advice for free. You don't have to pay anything. And I give you solid advice on just, investing in index funds. Just hold your investments. Don't pay anyone. You don't need to pay for advice. Just ask me or any of the other YouTubers if you need any advice. So good luck. Check out investingforall.net, and I'll see you in the next video. Hope you're having a fantastic Christmas, by the way. See you.